now. We have plenty of tech stocks on our radar, and Mastek is the one we're looking at. The company reported a good set of earnings for the second quarter. Their constant currency revenue growth the revenues were up both sequentially and year on year, although their margin dipped due to wage hikes. Hiral Chandrana, the global CEO at Mastek, joins us now to discuss this. Hiral, thanks a lot for joining in. Appreciate your thoughts. I want to understand from you how the situation in the second half is going to pan out. What are the demand trends looking like? Are you seeing any slowdown at all in key pockets like, say, BFSI or any other segments? And, what is the average growth that you can eke out in the second half?
Thanks, Sonia. Good morning. I am pleased to report some positive results quarter on quarter, like you said, as well as year on year. Our quarter on quarter for the whole business was 5.6% sequential, as well as 22.4% for the whole business. But even at an organic level, those numbers were a fairly healthy quarter on quarter, 2.7%, and closer to 20% year on year. What we are also pleased about is the order backlog, the 12 months order backlog. So we actually report that as well, because that's a true indication of the next 12 months, to your point about H2 as well. And those numbers were fairly healthy, again, closer to 20% year on year. As it relates to kind of the macro environment as well as the next couple of quarters, see, for our size of business and the focus that we have in certain markets and certain capabilities, while the macro does have some bearing in terms of slowness of decisions and delays, but it is really the micro and the elements of which geographies and which capabilities that we're focused on. So we are continuing to do well in the US market. We've had a healthy organic growth. Our UK public sector, which is a very strong business for us in the central government, is showing a lot of resilience with demand and pipeline building up. And feel that we can continue to maintain these levels going into the second half of the year as far as growth is concerned, both on quarter as well as year on year.
All right. Hi, good morning, Mr. Chandrana. You have detailed a fair bit about what's going on in the past quarter and the path ahead, but I'm looking for a couple of numbers. Now, in the first half of the year, you've grown by 16.5%, and margins are a little bit south of 17% at around 16.8%. For the year, what do you end up with in terms of growth? And do margins get back to, say, the 17.5% by the end of this fiscal? You did it a few quarters ago.
Absolutely, Nigel. So basically, our Q2 had the impact of wage hikes and salary increments. It also had a small impact of the Biz Analytica acquisition, which operates at a slightly lower margin than the overall company. Having said that, we believe that, as we've guided in the past, even though we don't give exact margin guidance, we want to maintain at a high teens level, right, which is the 17 to 19% range that we feel comfortable with. We feel that the operating levers, if you look at our utilization, if you look at some of the metrics that we have demonstrated in the last 2-3 quarters, quarter on quarter, is at a healthy level. So that is going to help us going into H2 to improve our both our gross margin as well as EBITDA. So we feel confident that by the time we reach Q4, we get back to that range that we were in Q1, which is in the 17.5 type of range. But again, we want to do the right things and make sure that we are investing in the accounts, investing in our customers. Very pleased to inform that we were recognized by the Everest Group as one of the top 5 Oracle Cloud applications providers. So some of that we want to leverage to fuel the growth going forward while keeping the margins in that high teens range.
Hiral, good morning. Prashant here.
Good morning.
Could you talk to us about the deal pipeline? I think you've got we have the 12-month order book. How is that situation panning out? Because we've heard commentary from other companies, etc., who've told us that the near term is soft, but in terms of deal signings, etc., it continues to remain pretty robust. Is that what you're seeing as well, or is it different for you?
Yeah, no, we are seeing our pipeline. Of course, our order backlog has gone up, but our pipeline has remained healthy and has gone up in at least certain sectors, Prashant. So we, as you know, right, we have a large business in the UK public sector, and there's a lot of technical debt in various policy decisions and frameworks that we participate in. And that whole modernization movement to the cloud is a multi-year journey. And so we feel that that will continue to give us resilient demand going forward. we are still, in the grand scheme of things, scratching the surface on major markets like US. Healthcare as a vertical, which we are focused on both on the payer and provider side, we see some good demand there, both on the front office as well as on the back office, both on our Salesforce business as well as our Oracle Cloud business. And so we are seeing some good deal activities moving from 5 million deals to 10 million deals in those sectors as well. So, yeah, I mean, while there are some uncertainties in terms of time it is taking to close those deals, right? Many of these deals are taking maybe 2 months longer, 3 months longer than we anticipated. But the pipeline still continues to be there. In fact, our demand has improved in terms of H2, in terms of open positions to fulfill. So we are seeing a good near-term outlook in terms of demand as well as deal pipeline, Prashant.
So, and one point of concern, Hiral, has been attrition levels, right? Your attrition is still quite high. It's almost 19%, while many of your peers have brought it down to about 15 to 16%. Why do you think that is? And what kind of attrition levels can we look at over the next couple of quarters?
Yeah, so Sonia, I mean, as you know, most of the business that we operate in is essentially all the digital engineering, digital experience, and cloud transformation business, right? We have very little legacy, kind of manual type of business. So the skill sets and the niche elements that we operate in is typically on the higher end, a lot more complexity on our programs, a lot more, even if you look at some of the deal wins that we've announced, these are complex programs that customers are trusting Mastek in. So there is going to be a slight delta there in terms of the attrition levels because of the niche nature. Having said that, our training programs, our cross-skilling programs, even the leverage of generative AI in the last few months has picked up. We're making sure that we take care of our employees, which is why we did not defer any salary increment hikes. We executed that in Q2 as promised. And we will continue to bring that attrition levels down in the coming quarters to make sure that there's no impact on the customers as well.
Okay, all right, Hiral. Thanks so much for stopping by and giving us a fair sense about how business is shaping up. We look forward to having a longer chat with you sometime during the quarter about maybe your probable inorganic growth as well, since you have some cash in your books. Well, let's move on then.